Hey folks, welcome to a product review at Finominal. Today we're going to look at JPMorgan's Strategic Income Opportunities Fund, which trades under the ticker JSOCX. Now, this fund manages slightly above $10 billion, and this share class charges 69 basis points. If you look at the fact sheet, you will see that the aim is to provide exposure to a variety of fixed income securities and to generate an attractive total return. So let's investigate in terms of how this fund has done. We're going to kick off with a simple benchmarking analysis. And in this case, if you look at the fact sheet, you will see that this fund has actually two benchmarks. One is the T-bills, and the other one is kind of like a US aggregate bond index. And we're going to kick off with this US aggregate bond index, this one from Bloomberg Barclays. And we can see that JPMorgan Strategic Income Opportunities Fund since 2009 has slightly outperformed the index. It's certainly been less volatile, to give them credit. We can also see most of the outperformance came basically from 2022 onwards. And that's, of course, when interest rates started increasing, right? And were longer duration funds, right? They could predict poorly. So that's one performance perspective. We can also see that the returns do not look particularly similar, right? So indeed, it seems that the portfolio from JPMorgan, one, it's probably it's an active approach, right? And secondly, right, that this is not the kind of like standard portfolio, right, as represented by the US investment grade bond index. Now we can run a factor exposure analysis. I probably wouldn't expect that we see much here. So this is a returns-based factor exposure analysis. Here we can see the betas to the major asset classes like equities, again, the US aggregate bond index, the US dollar, and the Dow Jones Commodity Index. Now we do see that there's a slight and consistently positive exposure to the S&P 500, but it's really small. We do see that the exposure to the US aggregate bond index was time varying, right? Went up, went down, and so on, which simply means that the fund managers sometimes they held investment grade, medium to long-term US bonds. Sometimes they didn't. Now, that of course, highlights the differential portfolio. We can also look at this portfolio from a risk perspective and specifically look at the drawdowns. Now, if we look at the drawdowns historically versus the US aggregate bond index, we do see that, they were from similar magnitude, right? Kind of like -5%, something like that, right? But at different times, except of course for the biggest drawdown in US bonds over the last, probably 40 years, right? 2022, which this fund almost completely avoided. And so kudos to JPMorgan. Probably what they did at that point, right? They went from long duration, or before that, from long duration into short duration bonds, right? Where they were more insulated from rising interest rates, which hit the US aggregate bond index quite negatively. Now, that's with regards to risk, right? We can also look at the diversification potential of this fund, right? If it would have diversified. And over the last 17 years, we do see that the correlation to the S&P 500 was 0.3, positive but small. Correlation to the US aggregate bond index, flat effectively, right? So that's quite interesting. If you want to quantify the diversification benefits compared to all equities portfolios, we can see that the Sharpe ratio of the S&P 500 would have been 0.75 over the last 17 years. If we would have allocated 25% to JPMorgan's Strategic Income Fund, the Sharpe ratio would have increased to 0.81. That's good, right? It shows that this fund generated diversification benefits. Now, this is for this fund on a standalone basis, but how does it stack up versus peers? We selected 4 other strategic income funds There's a lot of them, frankly speaking. And these are some of the largest ones, right? So you see products from BlackRock, Eaton Vance, Neuberger Berman, and so on. Now, let me actually add another one over here so we have that as well. The one from Fidelity. Here we go. And if we compare these kind of like 4 funds versus the product from JPMorgan, what we do see is that the well, JSOCX generated almost the lowest return, but we can also see it was least volatile. And so if you look at this from a risk versus return perspective, yeah, indeed we can see the product from JPMorgan, right? That was the least volatile one, right? Also the second lowest return, but of course that's fair and square. If you have low vol and low return, right? We can simply look at the Sharpe ratios, and I would expect that the Sharpe ratio of JPMorgan's product is quite high. In fact, it is the high with 1.36. Now, that's good. So low return, but low risk, right? That's all good with us. Now, so from this perspective, right, JPMorgan Strategic Income Fund looks quite good. We can also look at, just to compare the correlations of all 5 strategic income funds versus stocks and bonds. We can see that from a correlation to stocks, most of those funds, except the one from Fidelity, were lowly correlated to stocks, right, the S&P 500. But again, we can see that the product from JPMorgan was the least correlated to bonds. Now, that kind of like highlights an interesting and differential product. So is it unique? Now, one of the things we like to do is try to see if we can replicate funds. And in this case, what I've done is created a very simple portfolio comprised of a 50% allocation to high yield bonds and a 50% allocation to T-bills, because I know there's a little bit of equity in there. It's a yielding product, right? And within a relatively short amount of time, I found this combination which, well, looks almost identical to the product from JPMorgan. Now, that of course highlights that whatever JPMorgan is doing in terms of allocating across fixed income securities globally, which by the way also includes long-short strategies, right, is perhaps less attractive than when we compare it with its peers, because you can replicate it with 2 ETFs that are available at 32 basis points versus 69 for the product from JPMorgan. So that's perhaps worth keeping in your mind, right? That on a peer group perspective, the product from JPMorgan does look attractive. It would have historically diversified a decent equity portfolio and also bond portfolio, because the bonds are slightly, well, it's not very highly correlated to the US aggregate bond index, but there is nothing special going on here. And you can replicate this product with 2 ETFs and you get pretty much the same performance over the last 15 years. Hope that helps. Have a nice day.